In this video, I'm going to show you 8 different tax incentives that you can take advantage of to help you save and pay for education expenses. Using any one of these 8 government tax incentives can help you increase your cash flow and put more money in your pocket that you can use for college expenses. Actually, most farmers don't realize that if they just combine financial aid strategies with other tax strategies, they would never have to pay a dime for college education. So if your child or grandchild plans to attend college, here's what it takes to qualify for these education tax incentives. First, we have the American Opportunity Tax Credit. This is a tax credit of up to $2,500 a year for all 4 years of undergraduate college education expenses. And this is for each child that attends college. And even if you paid zero taxes, you can still receive a $1,000 refundable tax credit. Who qualifies for this tax credit? A full or partial tax credit is given to families with less than $90,000 in income, or $180,000 in income if you file a joint tax return. If you qualify for this tax credit, it's like getting $2,500 in cash from the government to pay for college. The American Opportunity Tax Credit is definitely the best deal of all 8 tax strategies. But now let's quickly go through the other 7. The next tax incentive is the Lifetime Learning Credit. This is a tax credit of up to $2,000 per year per family for undergraduate college education expenses. Full or partial tax credit is given to families with less than $50,000 in income, or $100,000 in income if you file a joint tax return. The third tax incentive is the student loan interest deduction. This is a tax deduction up to $2,500 per year per family for the interest that you pay on your student loans. Full or partial tax deduction is given to families with less than $60,000 in income, or $120,000 in income if you file a joint tax return. The fourth tax incentive is the tuition and fees deduction. This is a tax deduction of up to $4,000 per year per family for college tuition and fees costs. Full or partial tax credit is given to families with less than $80,000 in income, or $160,000 in income if you file a joint tax return. The fifth tax incentive is the Coverdell Education Savings Account. Here, you can deposit up to $2,000 per year into the Coverdell account and have it grow tax-deferred until you attend college, and then withdraw the money tax-free for college expenses. Another advantage of the Coverdell is you can use it to save for private elementary and high school expenses too. The sixth tax incentive is the Qualified Tuition or 529 plan. This is a tax-free education savings plan that is operated by a state or educational institution. Even better is the fact that the 529 plan is a great estate planning tool. You can make a contribution of as much as $65,000 to the college account for each beneficiary without incurring estate or gift tax consequences. The seventh tax incentive is a penalty-free distribution from IRAs. This incentive allows you to withdraw money from your IRA to pay for qualified higher education expenses without having to pay the 10% tax penalty for early withdrawals. You still owe normal income tax on the withdrawal, but you can avoid the 10% penalty tax on the withdrawal. The eighth tax incentive is the tax-free distributions from savings bonds. Here, the interest that you earn on Series EE bonds or Series I bonds can be used tax-free to pay for qualified higher education expenses. Okay, now let's look at an example of how the American Opportunity Tax Credit can work for families. In this example, we have John and Karen Frost, who are married and file a joint tax return. They have twins that are both freshmen in college. Their 2009 income is $160,000. And the total tuition and fees that they paid for the year is $8,000. The result? John and Karen Frost would end up receiving $2,500 for each of their two children over the 4-year period, or $20,000 in total. But what if John and Karen did not qualify for the tax credit because their income was $1 million? Well, if John and Karen did not claim the twins as dependents on their tax return, then the twins themselves could each claim the tax credit. That being said, there are some definite IRS guidelines that you have to follow, so you need to check with your CPA or accountant first. To get more money-saving ideas like this, go to the product section on our ffa.ag website. There you will find a number of implementation guides with step-by-step procedures that can save you thousands of dollars. This particular strategy on education tax incentives has its own planning and implementation guide and includes all the documents, forms, and contracts that are needed to help you and your advisor implement the strategy in your business and meet the IRS guidelines. You can purchase access to all these guides for only $99. But please, once again, if you download or print out the guide, you should definitely contact your CPA or accountant or even one of our certified farm financial advisors to discuss implementing these money-saving ideas. You can lose thousands of dollars if you don't have the right professionals by your side to help you go through this.